Okay, as we usually do, we want to start with what happened overnight, or in this case, over the weekend. Let's get this Bloomberg turned down a little bit. All right, that's a little bit better. The European market wrap is usually a good place to kind of get a grasp of what happened over the weekend or overnight. There's also one for Asia. At the end of our trading day, there is also another one. So you can kind of look back on the end of a trading day and ask that question. This is also a great spot to recognize if there's any speakers today. They will show up on FX Juice. Not always, right? We've seen surprise speakers before just pop up. But if it's on the schedule, then it'll show up. We got Brainerd speaking today at 2 o'clock. I say 2 o'clock because this is looking at my time zone, not Eastern time. Just the way it is. All right, so we do have a Fed speaker. We've also got the European Central Bank speaking today in a number of locations, and then we have additional auctions today. So a lot going on. I've seen a lot of comments about going short in the market, and I don't want to be the one that says don't do that and then talk you out of a trade and watch the market fall, another 100 points. But the basis of your trade should be built upon more than the market going down for 3 days in a row, kind of sort of convincing you that, hey, maybe we're actually going down. Really? Wait till it's fallen for 3 days straight and then decide you think it's going to go down and try to go short now? A little late to the game. But again, I'm not telling you don't go short. It's not my place. You want to go short? Go short. You're not trading with my money. On the other side of that, however, you might want to have that bias and then find a trigger to go short, right? You can think, I think we're going to go down. I think the market's going to provide me an opportunity to go short, and then find a short opportunity, not just instinctively go and put on a short trade just because you think we're going to continue this downward move. Find a signal, right? We had been using this higher time frame and running the linear regression line, and we had been talking about these higher lows and higher highs off of that May low. That is all gone now. We're back down into it. And if you kind of parse it out a little bit, it has the same characteristics of all of these other moves. It was just bigger, right? It lasted longer, but it still did the same thing that all these others did. We are at the weekly move already. So for those of you who are unfamiliar with that phrase, every week we get an expected move. And unlike a normal expected move that is dynamic and constantly changing, we use one that's locked in place on Fridays. So Friday at the close, these new lines were set up at 40.13.8 and at 37.99.7. Now we're looking at the futures market, and the futures market can't go to 0.7. It has to go to quarters, right? 37.99.75, 37.99.50. The same thing up here, 40.13.8. Well, the futures market can't go to 0.8, right? It's got to move in quarters. This indicator is running a mathematical calculation and then drawing a line there. So obviously it is not going to line up on a tick all the time. You have to distinguish where you want it to be, either rounding up or rounding down. And I promise you it won't matter, right? We're talking 1 or 2 ticks. It's not going to matter in the grand scheme of things. It's going to be okay, right? Don't get hung up on it. We did hit the edge of the move already this week. Generally speaking, if we hit the edge of the expected move on a Monday or a Tuesday, I go the other way. Normally, in a normal market, that's what I would do. But we're not in a normal market anymore. And now we just have to take it with a grain of salt. There are a few things to add into all of this. The futures are used as a hedging product because they have a hard delta. Market makers, institutions, trading firms who want to uh, get back to delta neutral in their options trades will use the futures to help them achieve that delta neutral position, right? Because that's how they eliminate risk. So, it, the new trader who says, "Who's buying all these options?" or "Who sold me this option?" Well, that's the market maker, and they're on the other side of the trade, right? They're on the hook. They got to eliminate their delta exposure, their delta risk. When the market starts to break outside the boundaries of its expected move, they will sell into selling because that is how they get back to delta neutral. They'll sell to get to neutral, but their selling causes us to fall more. When we fall more, they then have to sell more to get back to delta neutral, which makes us fall more. It's the same thing to the upside move. So this isn't a downside phenomenon. This is, hey, we broke outside of the expected move phenomenon. A lot of times, breaking slightly outside of the expected move doesn't trigger this reverberation or feed loop that drives us into untenable ranges most of the time. 2018 was an example where what they called the volatility locker or the hurt locker. It was a volatility trap from October up to the dump right before Christmas. That time period was exactly the same thing. The very first week of that drove us to deep lows, and every week it ends. It ends on Friday. So thank goodness, something like this wouldn't trigger and just continue to feed loop for weeks. It ends every Friday. So a 1 sigma move, not that big of a deal. You start getting into a 2, maybe a 3 sigma move, it will pick up speed. It's one of the reasons that the move does accelerate so far when we get outside of those expected move boundaries. So if we're on the edge of the expected move this morning, half the day is already done. We want to watch this move outside of the expected move and see if it starts to get worse in the later part of the day. Looking for breakdowns from those critical level and how the tape responds when we retest those lows. Should we retest those lows? Now, that comment about hedging and buying into buying and selling into selling, this isn't something that I'm just pulling out of a hat, right? It's not a rumor, it's not some theory. If you wanted to, say, go to Google and search for negative dealer gamma, you could read more about it, kind of get a better understanding that it's not a new thing. It's been around for a long time. And speaking of options and gamma and dealers, it's OPEX week. And this is a big one. This is a real big one. Options expire on the third Friday of the month when we're talking about options expiration on the monthlies. So it's a doozy. It's not just that, there's a lot more than that. All right, for the day, let's get our levels. Excuse me, let's get the calendar. Econ, 11:30 today, additional auctions. These auctions can often be game changers, taking us from the low of the day and galvanizing us towards the open, or from the high of the day back towards the open. I've seen significant moves come through the marketplace right at 11 o'clock or 11:30 or 1 o'clock with these additional auctions. Now, they say causation is not correlation or vice versa. Maybe it's just a coincidence that when I recognize these additional auctions at 11:30 and then we see a market break and run right at 11:30, maybe it's just a coincidence. It's possible. But it would then still imply that looking at the clock at the half hour and the 1 hour mark is often when we see a change in sentiment due to maybe some other report that we didn't quite know was coming out. And it could be as simple as grain shipment reports. If you go to Econo Day, which is where Thinkorswim gets its data, you'll realize that there's two different data sets. The one that we're looking at here, and then the other one for commodities. How many commodity reports come out in a week that none of us pay attention to that very likely has a significant impact in the market? But it's boring, it's not sexy, they don't talk about it in the news, and none of us go look at those reports. And so none of us catch it. All right, let's break out our levels. The red bar at 39.27 and 38.26, that's half of the expected move. The orange bars at 39.78 and 37.76, that is the full expected move. It's based on where we opened here in the Globex Sunday night, not based on where we closed Friday. It's important to recognize that. Good morning, Eric. So that is our AD levels for the day. Keep in mind that the AD levels are what we would consider a normal move, not an extreme move, right? So we could easily go to 37.76 and it wouldn't even be considered an outsized move. But from the open Sunday night, if we were to fall 2.65%, then we would be at that orange line, 37.75. Right now, we are outside day. We are outside of Friday's range. To get back in that range, we would first have to get through the Globex open, which is a pivot point. We would have to get through the low of Friday, then the close of Friday. There's more than one. And then the open of the RTH session, then our ADR high, and then the Globex high of Friday. So as you can imagine, any move to the upside is going to come with significant resistance because all of those levels are over our head, right? And each one of the ones that I just named, they're all institutional pivot points. They're not just random places where price turned and went the other direction. I did mention more than one close. You can see, for an example, where the last candle printed, and yet that's different from the 4 o'clock close. So if we were to go out to the daily, it actually lined up. So normally that doesn't line up. Normally, if you go out to the daily, it shows you a 4 o'clock close, and that happens to be different than the 5:30 close. We'll take it, right? For once, Thinkorswim gets it right. So now we've got the RTH low, the 4 o'clock close, the Globex open, and all of those pivot points would be our overhead resistance. If we were to continue this move to the downside, and right now there's no reason to suspect that we won't, we would first challenge the Globex low, which happens to line up with the weekly expected move, and then the ADR. Now, when I'm looking for an extreme, if I'm wanting to calculate the base case argument for what if we really get nasty today, right? They've been talking about it for months. One of the reasons that we're not done with these lows is because nobody's capitulating. What if we actually had capitulation today? What would it look like? And that's a really interesting question. And we need a way to do this with some consistency. And the way that I approach it is I look at the ADR and I consider if this is normal, right? If a 2.65 move in the market on a day-to-day basis is normal, and I'm looking for something beyond the norm, then I want to at least add 50% of this. And you could just completely double it too, right? You could kind of take it either way or both. I don't think that there's an argument that says you only can do it one way. Why not both? If you took 50% of that and added it to it, say 2.65, which gives you 1.32, add that to 2.65, you get a 4% move on the day. And that's a 50% addition to what we already got there, right? So let's just throw that out there. That would be considered kind of extreme. Sure. So if we took 2.65 and we multiplied it, that would give us 5.3, and that would be extreme. Now, I know not all brokers have it, but Thinkorswim has a pretty dynamic drawing tool. So if you use the trend line, snap it from where we opened in the Globex, we can look at what a 5.3% move would look like. And that gets us down to 3670-ish. That would be our extreme case scenario. Right? And this way, you get your emotions out of it, you get your feelings out of it. Nobody cares what you think. You just put the numbers together, right? 50% and then 100% of the average daily range. Same thing for the upside move. It is very likely we're going to continue to make significant moves over the next few days, but keep in mind we have the FOMC Wednesday. On a side note, be on the lookout for the plunge protection team. Now, they've been dormant like they should be because they want this market to sell off, but they showed up when we triggered that 20% move off of the top when the S&P went into bear market territory that day. They popped up on Fox that day. They came out in full force and tried to stabilize the market. The plunge protection team was working that day. And that's not some theory. That is another real thing that exists. If you were to go and Google the plunge protection team, you would realize that that is a real thing. It's been around for a long, long time, and that they absolutely can manipulate the markets. It's not like they have to go in and try to buy across the board or turn the algos on, and they don't have to do any of that. All they have to do is go out and start chipping their teeth about policy. And they can manipulate markets by those words, right? So you want to be looking for them today, tomorrow, into Wednesday. The idea that we're in blackout mode, that there should be no Fed speakers right now because we're going to be coming up on the FOMC. They all go dormant. They go into a blackout period. Why is Brainerd speaking today at 2 o'clock? I don't know. I find that unusual. I don't know what to do with it. I definitely want to point it out. But at least this one's on the books. What we want to watch for is a Fed speaker who's not on the books popping up somewhere. On the day that the S&P triggered the 20% decline from the year's high, a Fed speaker popped up on Fox. I don't watch Fox. He caught me by surprise. He wrecked the trade that I was in, and the market absolutely responded to him speaking, but we didn't know he was there until it started showing up on Finance Juice. So just be aware, be cautious, look for them to show up somewhere. And keep in mind, for any swing trades that you're thinking about, it is a Fed week and it is OPEX week. I heard some numbers on Bitcoin. 18 was the number I heard. Right now we're at, say, 23 half. It has not stabilized the way that the other markets have. Say the S&P, is putting in this little micro double bottom soon, or the NASDAQ perhaps maybe putting in a micro double bottom soon. Oil is stabilized along those lows. ADR is average daily range. Think of it like ATR, except ATR uses a weight very similar to an EMA, whereas an ADR is more of a very simple calculation, like a simple moving average kind of calculation, right? So ADR, ATR, SMA, EMA, kind of the same logic behind it. Average daily range. Mine's a 21-day ADR. The VIX did wake up a little bit. It's good to see. By the way, it had been dormant for a significant period of time. If you think about the angst and the moves that we've been seeing in the market and the lack of any response out of the VIX in the last month or so, it is good to see that the thing is finally waking up. When we bring up something like the VIX, it's always interesting to take a look at this tab here called product depth. We're going to look at the Vix Futures. When you have date and time, you have a normal curve and then what they call a backwardation curve. In contango, which is what normalcy would look like, we would travel from a more left to right sort of thing, right? Things that are close in time tend to be cheaper because there's less unknowns. And then things far out in time tend to be more expensive because there's so much more that could happen that are just so unknown. Supply chain issues, bad weather, changing regimes in government. There's so many things that could go wrong in the future that, typically speaking, the future is a more expensive thing. That could be for interest rates, uh, shipping costs, or in this case, volatility. When we're not in contango, which is what that yellow line would look like, contango, when we're not in that, we are in what they call backwardation. And that is when the things that are very close in time are much more expensive than things that are very far away in time. We're looking at February 2023, and the curve is headed to the downside. This is because these different VIX contracts have their own settlement dates, and each one of those can be plotted on a graph like this. Well, there's something else that has dates connected to it. That would be things like the futures products, the S&P and the NASDAQ. Look at this chart for an example. Consider what we were just talking about. That is a natural curve for contango. Things that are close in are cheaper than things that are farther away. This very often reflects where the institutions are thinking the S&P is going to be in the future. By December of 2024, they expect us to be moving back to the upside, coming up out of these lows. But I don't think anybody would suggest that we're done with these lows yet, right? So what I did here is change the dates of the look back to see what did it look like last week? Where was their projections of where the S&P would be? There's a lot you can do with this. Kind of look it up on the Ticker Tape, which is a publication by TD Ameritrade on how to run different parts of the Thinkorswim application. But if you really wanted to see those contracts in better light, you can go to the options tab here across the top, set it to single, show all. You can see right now we're on the U series. The M's are going to be expiring in 4 days. It's more of that OPEX, right? We're coming up into this very massive pool of money that is going to be expiring out of the marketplace. But when we're looking at these expirations, we can see the cost of them, the volume on them, and where their last is, right? So we can see that curve. What are they pricing out into the future? How far away is that future date? And what kind of volume are we seeing out there? Well, you can see the volume's pretty light this morning for March, December, September. We're on a normal day, I would have expected to see our active contract way more than 411,000. There's a real light volume out there. Again, this should cause concern. Light volume uh, is often the beginning catalyst, very big moves. The MES doesn't look much bigger, not much better. Right, so just be very careful out there today, guys, and this week, right? Because of the FOMC, because of the OPEX, there's just a lot on the table. Approach with caution any of your trades. Trade, what they call paper hands. Lock in those gains, protect your profits, and get out again. I know plenty of traders who walk away during Fed week. They take vacations, they go fishing, they do something else. Now, that's not my style. I don't just walk away and come back afterwards, but there is a logic behind it, right? We want to continue to watch the dollar. The dollar right now is our global risk gauge, so to speak. It's like a VIX proxy for global money. A lot of those global fund or firms, they can't go to cash. They would pay such a penalty to go to cash that when they would go to their shareholders or to their clients and try to explain away those losses, how how would that sound? Well, I lost your money. Oh, well, at least you had a good idea, right? You invested my money in something and that something didn't work and you lost me money. No, I lost your money because I got scared and I pulled all the money out of the market and then I paid a fine and I lost your money because I paid that fine. How do you think their clients would respond to such a conversation, right? Not so much. So if they have to stay engaged, if they have to keep that money in the market to avoid those kind of fees and penalties and fines, where are they going to go? Bonds? No, they're not going to go to bonds, right? Stocks right now are going down and bonds are going down with it. What are they going to do? Go to gold? Yeah, maybe, right? But gold is the hedge trade. So that doesn't leave a lot of places left, right? Where do they go? They go to the dollar. And it comes down to that old phrase, our junk is better than somebody else's junk. If you're going to put it into a nomination, right? And this isn't the US dollar, this is the dollar index. You're not going to go to the ruble. You're not going to go to the peso or the yuan, right? And put it in the dollar index. So it becomes a proxy for risk in markets, right? In environments like this. We want to see the dollar and the VIX moving together. If this decouples, breaks away and starts doing its own thing, heads up, tighten your positions, get out, watch for a significant change in market sentiment. It is often a great warning. Right now, we do have stocks and bonds moving in the same direction. Keep your eye on this. We want to see them decouple. Are they going to break away from each other and start having something different go on? There was more than one time last week when everything, oil, bonds, gold, Bitcoin, and stocks were all going in the same direction. The only thing that wasn't going the same way was the dollar and the VIX. That is a highly, highly correlated market state. A highly correlated market state is one of the most dangerous and extreme market states that exist, right? When everything is doing one thing. It is where the biggest moves in history have ever come out. We are looking for capitulation. That is right, Brian. Yep, it is the dollar index. We are looking for capitulation. That is a fancy word for extreme move. It is the last hurrah, the last spot. It's the place where everybody finally gives up and dumps their position. If you look back in history, it very often becomes a V bottom. It's that last spot where just nobody can take it anymore. Max pain is another phrase for it. So we are looking for an extreme capitulation move. And for calling the bottom, even though they say calling a bottom is very hard to do or it's very impossible, I don't completely disagree with that, but impossible is a word I kind of choke on. There are a lot of things that we can use to validate, hey, was that the low? And if it ends up not being the low because later on we happen to come back, well, that could have been the low at the time. And until something happened that broke our rally, that may have been the low. But was this one back then the low? No, it didn't have all of the characteristics that we would be looking for. There's literally a checklist for calling bottoms. And it doesn't mean that you're going to get it right all the time. But if one out of the 5 things on the list happened, that's not very confident that it's the bottom, right? 2 out of 10, yeah, maybe. When you can go through the checklist and check every single thing off the list, calling it a bottom, you're very likely to have seen that that is the bottom. So capitulation is one of those. What it looks like is a massive down day with either an end of day rally or a rally in the Globex after that down day on significant volume. And I mean significant volume. The way that IBD says it, and of course they don't put it in print this way, but it's not supposed to be like, oh yeah, that looks, oh yeah, it's a little bit of volume. They say it should be, oh damn, volume. It should be volume that's so big that when you look at it, you say, oh damn, that kind of volume. So when you're looking down at the volume and you got this just a little extra volume, it's a little more volume than you had yesterday. That's not the kind of volume we're looking for. We're looking for the kind of volume is, oh, damn, that's a lot of volume. So it's not subtle. It won't be sneaky. You'll know it when you see it. And if you go back and look throughout history at when there were the bottoms, that's the kind of volume that you would want to see. I think we covered just about everything I wanted to cover. We didn't get into equities. There's really not much to touch on the equities. Energy is way overbought. I hate the phrase, but we'll say it anyways. And yet it's not slowing down, right? We haven't seen a blow off top in energy. So we just, tiptoe into it, continue to maintain the positions as we can, and look for any kind of topping patterns to warn us to get out. Energy's been a great day trade. So has finance. Remember that if we're going to see a rally today, we're going to need it to come out of one of the 3 main risk on sectors: finance, technology, consumer discretionary. Right. So the MOTs, the monsters of tech: Apple, Amazon, Meta, Tesla, Nvidia. If we use the checklist that ICE uses for the European exchange on their NYSE FANG list, then it also would include BABA, um, Baidu, Twitter. I don't necessarily agree with their list, but it is their list, right? They didn't ask my opinion. So keep your eye on the MOTs, watch the sectors, and I will see you all in the Bullish Bears at 9:15. It's my day to stream.